Okay, Gabriel says move stop to break even. The thing about it is my approach to trading when I'm doing it generally is that I want all my energy and focus to be on that. You know, when I'm trading, the cell phone shut off. You know, I'm not checking email. I'm just trading. That's what I'm doing. You know, and so I want all my energy, I want all my focus, I want all my awareness, and I want all my experience to be dedicated towards that moment and that trade right there. And if I am, you know, involved in a trade and teaching a webinar, my skill set is not going to be fully dedicated to teaching, and it's not going to be fully dedicated to trading. In fact, there's a lot of neuroscientific studies that show when you're multitasking, you know, for example, let's say you're talking to someone and writing an email, your IQ actually goes down because you're not able to dedicate the resources that you want to. Trust me, I wanted to be in that trade because that trade was a fantastic entry. I'll go over it, and it's almost going to activate another long, which would have on another signal, which would have given it a nice boost. But again, when I'm trading, I want my energy to be dedicated to that. Otherwise, I'm using some of my resources for other things that aren't as important. And so, yeah, exactly, no multitasking while trading. And that's why I don't do any email, I don't do any phone while I'm trading. Whether it's 30 minutes or an hour or 4 hours, that stuff is shut off. You know, Jesse Livermore had a very similar style that when he was trading, blinds were closed, you know, nobody was allowed in his office. He even had his manager of his office was actually kind of like a pseudo bodyguard at the same time, so that only the absolute most important people would be able to enter his room while he was trading or involved in making trading decisions. And so with that being said, you know, you're going to have a lot more intelligence and you're going to have a lot more focus if you're only doing that while you're trading. You know, and that's why my office is completely separate. In fact, my new house, my office is in a separate building. I have 3 buildings on my house. I have a guest house, I have the main house, and then I have my office. And so my office is completely separate from my main house. So I don't have to worry about my cats banging on the door or anything like that, or the guests worrying about me. It's also on the 2nd floor, so it's more energetic, conducive to, you know, more creative thinking. So that's how I wrap it up. And so that's why I don't want to be in a trade right now, even though the trade was a very good position and, you know, it's progressing. I wanted to be out of the trade because I want to be focused on this. No girls allowed. Absolutely not. That's probably for me one of the bigger distractions. So, all right. So welcome back, everyone. It's great to be back. This is the first webinar of 2012. In fact, it's still kind of strange sometimes to be saying, hey, it's 2012. So really good to be back. I hope you guys had a great vacation and great relaxing time. You know, I usually use that to reflect on things that I've done in the past. What do I want to build in, you know, skill set for this year? What do I want to accomplish? What do I want to work on? And then I set a plan of action, and then I start working on it. And because also there are less clients to deal with, you know, I don't have to send trade reports to, you know, some of the clients of the fund or anything like that. There's less communications. It gives me time to research new ideas that have been, you know, kind of building and brewing in my mind. And I'm going to be sharing some of those things that we and my programmer came up with in our holiday time off. So very excited. The new format for this class, I have pretty much all of it done except for one thing, and I'm still filling this out. But we're going to keep one part of the old format, which is that in the very beginning, I spend a few minutes talking about a particular aspect of trading. It could be a story, it could be a personal experience, whatever, to help, you know, unwrap different aspects of the trading life so that you can use that for your benefit. You can apply them to your life. So that we will begin with that. Then we're going to be getting into various trade setups. But here's the thing that's going to differ. We're going to be doing, I'm deciding if it's going to be 2 weeks or, you know, 2 weeks on, 2 weeks off kind of thing, or 3 weeks on, 1 week off. But the majority of the price action analysis we're going to be doing is going to be on the 1 hour, 4 hour, and daily time frames. But as I said before, not everybody trades that. there is, another spectrum of traders that are doing price action analysis, and they're doing it on the 5-minute, 15-minute, lower time frames, 1-minute time frames. And as I said before, 90% of the price action tools and techniques I'm using on the 1 hour, 4 and daily time frames, I use, if I was trading a 3-minute time frame, I'd be using there. So it's virtually the same skill set. And the reason why I spend most of the time teaching the 1 hour, 4 and daily time frames is for developing traders, you're going to have a far easier time learning on those levels than you would on the smaller time frames. One, because you have more time to kind of look at the setups and kind of do your analysis and to gauge your stops and everything like that. But there's also more data contained inside of a 1 hour, 4 hour daily time frame than there is on a 5-minute candle. So you're just going to have more data. And so because you have more data, you're getting a broader perspective. The higher you go in the time frame, it's kind of like the higher the view you have in the building. The lower you go in the time frame, the closer you are to ground level. It's not that one perspective is better than the other. If I'm looking for, to decide whether, hey, traffic is busy or not, in my city or something like that, I'm going to want to be high up in a building to see the overall traffic pattern. I'm not going to necessarily be able to see that on the ground level. But sometimes there are going to be things that if I was 24 stories up, I would not be able to see if I was on the ground level. And so it's not that one's better than the other. They just offer different perspectives. And they offer different opportunities and different ways of trading. And so with that being said, we're going to spend at least 1 week, maybe 2 weeks a month, just focusing on trading on intraday, really short intraday time frames like 5 and 3-minute time frames. I'm going to be using the 3 minutes for that. You're welcome to use 5, 10, 15, or 1 minute. That's fine, but I'll be talking about the 3 minutes and how you can do price action trades in it. And by doing that, that's going to give this class a much broader range. That means for those of you that do trade the intraday time frames, you're going to get what you want in that, and we're going to get these 3-minute, these intraday, really short intraday looks. And for those of you that want the 1 hour, 4 and daily time frames, maybe you don't want to spend, 5, 6, 7, 8 hours in front of a computer. Maybe you just want to make your trade and then go play golf or whatever it is. One's not better than the other. It's just different. And so this way we'll have a range for that. And this way we can satisfy everybody. So that's the format I'm considering. Either 2 weeks, 1 hour, 4 and daily time frames, 2 weeks, 3 minutes time frames, or I might just do it where I mix them both inside the same class. So I don't know. Maybe you guys can vote on that. Maybe you guys think, hey, we should just mix every single class. Or we have some trading that, we have some classes that are just 1 hour, 4 and daily time frames, and some that are, the 3 minutes. What do you guys think? If you guys had to vote on that, what would you choose? James and Kesta says mix. Chima says mix. Sounds good too. Mix it. Show the descent. High to low single. Half and half. Seems pretty well overwhelming mix. So with that being said, I'd say mix, one for each month. Separate. Okay, so it seems like the general is mix. What we could do is we can actually do both. We can have maybe the first half is 1 hour, 4 and daily time frames, and the second half is 3 minutes, or we can just mix them on the fly. Drydo says, I would propose more longer time frames, but shorter whenever there are good examples. Okay. All right. Well, I'm never going to present something if there isn't a good example. If there's not good examples, it's not worth it. So you can count that I'll always be doing that. But we'll try the mix for now, and if everybody really seems to be down with it and jiving with it, then we'll keep it up, and if we need to separate it, we'll separate it. So let's play it out in real time and see how it goes. With that being said, there's another addition that I want to add to this, which is that one of the things that my programmer and I have been working on is breaking price action down into a quantitative perspective. The market is both order and chaos. Life is both order and chaos. And therefore, we need to, the most balanced approach is to look at things from price action, particularly from a more objective and then a more subjective perspective. And so when we do discretionary trading or subjective trading, we still want rules in place. But the other side of that, the other side of subjective discretionary trading is completely objective. And one of the ways to do that is to get pure data on price action. And that's something that I'm really looking forward to bringing forth and sharing in this class, because we've been able to gather immense amounts of quantitative data on all kinds of things, stuff that I couldn't find anywhere. I've looked everywhere for quantitative price action data, and I just can't find it. You know, the simpler aspects of it would be, hey, on this formation, what's the percentage chance it's going to break north or break south or hit this target based on this stop and this entry? That's a simple version of it. And then there's more detailed versions of quantitative data. For example, what's the max consecutive bars that were above the 20 EMA on that particular time frame? Or what's the max consecutive bull bars in a row, or bear bars, or consecutive highs above the prior high, or closes above the prior close? That is all very, very powerful data. And as I'm mining this data, you know, we're finding all kinds of unique patterns about pairs on all kinds of time frames. This algo that we have measures for about 16 different price action metrics. We just attach it to the chart on any time frame we want. It goes to the max bars in history for its analysis, and then it turns it into an Excel sheet and spews out the data. And that data has some incredibly valuable gems of information on it. And so some of those things I'm going to share today with you. Probably once or twice a month, I will be sharing this kind of data, and so, or pieces of this data. Most of the data is going to be reserved for my course members, and some of it will take some unique aspects and put into the upcoming book. But I will take small portions of this data and release it over time, small little pieces here and there in this class. So, you know, little bits on pairs here and there and things like that. So that's what we're going to be sharing with, and that's what we're going to be starting off with. Okay, so with that being said, I want to talk about the chart that we're looking at right now. This particular move on the Aussie US dollar, if we look back a little bit, we can see that, and we go actually to a daily chart, we can see that Aussie US dollar has been building kind of a bullish structure to some degree, but it's been kind of stuck over the last month and a half between 103.29, 103.82, really like 103.30 and 104. It's been stuck in this range here. But as you can see, it's been building a series of higher lows. The structure continues to build. And on top of that, if you look at, let me delete these right here, the bounces, you know, other than this bounce right here, this bounce took, you know, about a few candles and then it bounced, this bounce took a few candles and then it bounced. But once the resistance became just sub 104, the bounces off of that, you know, coming up to that, usually took a few candles to get there. However, the most recent bounces have been generally one or two candle bounces, and they've been bouncing, suggesting that the bulls are picking it up faster, and that the rejections are also getting more and more shallow. This rejection took a while and then sold off pretty deep. This rejection along the same level was much quicker and less deep. So its overall structure is suggesting that the bulls are slowly scooping this up, and they are scooping it up a little bit faster and a little bit higher each time. So they're starting to take control of the overall structure here. They haven't really kind of punched through some of the key levels, but they're starting to kind of slowly take control over this. And I think they're probably going to win this one. So we can see the overall structure, and we can see that there was pretty decent resistance here after this point. We can see there's pretty solid resistance over here. Now, it's this little move here. This is a pretty strong move, you have to admit. You know, 3 candles for it to go from 96.75 to 103.36, you're talking roughly 700 pips inside 3 days. That's a pretty powerful move. And so with that being said, I want to look at this on a 4-hour time frame, and I want to show you something from a quantitative standpoint that really cued me into saying, hey, this move is not going to make it. And let me show you why. So here's this move right over here. One of the quantitative pieces of data that we measured that I wanted to know about was, what are the max consecutive bars price could be above the 20 EMA? And so the basic qualifier was, once we had a close above the 20 EMA, how many bars could continue to push above the 20 EMA and stay above the 20 EMA without actually touching it? Why is that valuable information? Well, it kind of gives us information about a pair's trending abilities. There were many pairs that had many more bars that it could stay, say, on the 4-hour time frame above the 20 EMA than others. Some of them could only stay above the 20 EMA on a 4-hour time frame for maybe 15 bars or 20 bars. But there were other pairs that had much greater capacity to stay above the 20 EMA. That communicates that it has a greater capacity to trend or to hold those trends when they come in place. If you're holding above the 20 EMA and you're not even touching it once for one tick, well, then that shows that you have a pretty strong ability to hold above the 20 EMA and trend strongly. So that was one of the metrics that we were measuring. Another metric we were measuring is, what is the max consecutive bars, bull bars we could have in a row? So in other words, how many blue bars could we have in a row that were, all blue and no red? That's very valuable information to us, especially if we want to fade a particular move that we think is extreme. We can look at the quantitative data and say, hey, wow, this is pushing the extreme values of this. It's not that it can't break it, but on a 4-hour time frame, our data went back over 7 years. So within the last 7+ years, this thing has never been able to push more than X amount of bars consecutive bullish in a row. And now we're approaching that. So if I'm looking to fade that, that's a very good piece of data to have. And so hopefully you can start to see how quantitative data on pure price action can be incredibly valuable if you want to fade a move, if you want to stay in a trend, if you're worried about the trend ending, or anything like that. All very valuable stuff. Well, one of the moves here that we were trading was Aussie US dollar. We were definitely trading a lot of longs on this particular move here. But as it started to approach and started to continue to, these higher ranges, particularly this little move right here, this is an extreme candle. It's a pretty rare candle. And anytime I see an extreme candle or a rare candle, then I'm very interested in that. And so with that being said, that either means that there's a great move in the same direction, or there is a possible reversal coming up. And so with that being said, this was a very unique candle. We've been above the 20 EMA, and I want to show you something here. Take a look at this move here. Now from here, this is the first close above it. When we get to the high of this move here, this was on the 1700 hour, 5 p.m. California time on the 27th of November. The amount of candles between here and here is 3, 6, 9, 12, 15, 18. About 20 candles. So 20 candles up to this high up here, when we had this strong rejection after a very powerful move. Now I want to show you something else real quick. I'm going to switch the camera off, and then I'm going to put it onto this Excel chart. Tell me if you guys see the new Excel chart. Okay, great. So these are just a small fraction of the quantitative analytics that we've been doing on this particular pair, Aussie US dollar, on the 4-hour and 1-hour time frame. And I'm going to talk about how I was able to use the analytics on the 4-hour time frame and then some of the analytics on the 1-hour time frame to combine these two pieces of information together to say, hey, this is going to be my trade, and here's why. If you look at this here, Aussie US dollar on the 4-hour time frame, the max consecutive price above 20 EMA. In other words, how many bars after a close above it could it remain above the 20 EMA? Well, over the last 7+ years, 42. 42 4-hour candles was the max. The max consecutive bull candles it could do in a row on a 4-hour time frame was 9. So the max consecutive climb, blue candle after blue candle after blue candle in a row, was 36 hours straight. After that, it had to at least produce a red candle. The max consecutive high, since this is an up move, I'm really concerned with the analytics around an up move. The max consecutive highs above a prior high would be 12, and the max consecutive closes above a prior close is 9 as well. So let's concentrate on this one right here. Max consecutive price above 20 EMA. Now what I'm going to do is I'm going to take the camera off this again, and I'm going to come back to this chart. So now, here we are. We've hit a resistance level, obviously, with a very strong rejection, to the point where the wick itself, the rejection, was stronger than this actual bullish move itself right here. We opened, we barely went down, means that the buyers bought from the open. We climbed from a low of 101.66 to a high of 103.28. We climbed 160 pips inside 4 hours, and we were bought from the open. So there were serious buyers from the open that were coming in, either coming in on the open of this candle, or they were still in from this candle. They push it up 160 pips, but then all of a sudden they hit this 103.28 level, and then reject to the point where they close at 102.41. In other words, they basically climbed 160 pips and then dropped 90 after hitting this from the high. That's a very strong rejection. So we've been bought from, we've had this massive buy up here, which is almost 200+ pip candle. We open, we have about a couple pips to the low. We buy up straight from the open 160 pips north, and then we reject 90 of that 160 pip gain. That's more than half. That's a very strong rejection. And so that's communicating to me, this might be a key level to fade it. Well, let's take a look as we start to get closer towards this again. But let's take a look at our quantitative data. Remember the number? Max bars, 4-hour bars above a 20 EMA after a close. Well, here we have 3, 6, 9, 12, 15, 18, 21, 24, 27, 29. So we have 29 candles up to this point, only about 13 away. I didn't get this candle right here on this rejection the second time around. I was looking at this saying, hey, it rejected off of it, made a base low here, but then it started to form a higher low here and started to buy up after that, suggesting it may want to break through. So I didn't take the short on this one here. It rejects off of it, and it comes right back to this same level at 102.08. Then it starts to build some price action to open up, and I start to look at this and say, wait a minute, hold on. We're pushing the max number of bars here. At this point, this was 29, so 31, 2, 3, 4, 5, 6. So now we've hit 36. 36 bars, and over the last 7 years, this thing has never produced more than 42 bars above the 20 EMA. That's telling me, and keep in mind, that 42 was a very extreme value. So if the 42 is the max bars above the chart, and we're already at 36 pushing into this, is this going to probably be a legitimate breakout? Even if it does break out on the next candle, we only got about, 5 more bars before it's going to return back to the 20 EMA. Unless we just happen to be setting a new historical high here, which doesn't happen that often. So with that being said, I'm looking at this candle and I said, you know what? We are damn close to this right over here. Look at where we're at. We're right at a round number. We've got a round number right here. We've just touched it, and then we close just below it here. I'm looking at this saying, oh my gosh, I got roughly a 32 pip stop, and I have at least a move back to here, which is about 90 pips. So I have about a 32 pip stop and a 90 pip target. It's a roughly 3-to-1. Let's take this trade, and look what happened. It accelerates right back to the 20 EMA. So this is how we can use quantitative data on price action to be informative of the moves we're going to take. Maybe you were thinking breakout, and having this kind of data is incredibly valuable. We can be like, I could take a breakout, but this thing's probably not going to go much beyond it without returning back to the 20 MA. Or I can take the breakout, but then I can look to fade it back to the 20 MA. So that is very powerful quantitative price action data. Can everybody see how that data was very useful in informing me how I wanted to take this trade? Can everybody see that? Yes, no? Okay, great. Now a couple questions on this. Thomas says, would you consider to do analysis on the S&P? If we're able to make it through the instruments I want to cover today, then I'll be happy to take a look at the S&P. I generally like to concentrate mostly on Forex because that's what, this class is really about. But if I have time, I would be interested. I might be able to do some S&P stuff. Just depends if we can make it. Flat top triangle. Yeah, I'm not really too big a fan of flat triangles as a whole. They're pretty bad patterns. They rarely play out the way they're supposed to. They have a high failure rate. Not a big fan of that, triangles as a whole. Especially patterns that require like 60 candles. You have so many moving parts in something that requires 60 variables. So I'm not really interested in triangles as a whole. Joe says, could you look at Euro US dollar? Kind of the same thing with the S&P. I want to get through my instruments before I do that. Michael says, I think Rob Booker did the stats on price staying above the 800 SMA and then created his oscillator indicator. I can't really comment on that. To me, doing stats on something above an 800 SMA, which is not really that valuable. The 800 SMA is something that it's not going to produce a lot of frequent trades, to be honest. So to me, that's not really that interesting. I want something that is not just something that's going to be useful to a common reference that a lot of institutions are going to be looking at, but also something that produces enough frequency for me to trade it. Otherwise, it's not very useful if I get a signal once every 2 weeks. So that's my thoughts on that. Jano says, does it matter that this extreme candle was formed during a period of low volatility? Yes and no. At that time, you got to understand, coming into November, we only had a small blip of lower volatility, but when that all extreme happened, we were at the end of November. So the markets were back in it, and they were coming into their last surge of volatility. I wouldn't call this low volatility. I wouldn't call the Aussie US dollar climbing 700 pips in 3 days low volatility. I would call that high volatility. So that's my thoughts on that one there. So hopefully answers your question. Okay, Harley says, will you stay in a trade, say if price was below the 20 MA, even if it becomes really choppy? That's kind of a vague question there, Harley. I'm not really, it's hard for me to answer that because it's not really specific. Would I stay in a trade as, say, if price was below the 20 MA, even if it becomes really choppy? That would depend on the trade in the system. If I'm doing a with trend trade, I don't really want to be involved in too much chop now, do I? If I'm looking for a fade, it would depend on the type of fade that I'm doing there. So the question to me seems a little vague for me to want to answer that. I need a more specific context. Otherwise, it would be hard for me to really give a valuable answer to that. Chum says, where can I get those historical data of max candle above 20 MA? You can't unless you have a really good programmer who's able to do that. How did I get it? I had my programmer do it, and I paid him to work for many, many hours to get all this price action data. As far as I can tell, the only person out there that's producing quantitative price action data is me. So it's me, myself, and I. Tell me where you can find quantitative price action data, and, especially stuff like this, I'd be happy to find out. I'm just not finding it out there. Most of the people that get quantitative price action data, they keep it to themselves. They use it for all kinds of trade systems. Usually it's institutions. So most people don't have that data. So the answer to your question is me. And it's not something I'm going to release that whatever pieces I want when I want. Okay, what was the trigger for the entry on this one? Okay, I think I covered that, but the trigger for the entry on this one, Jano, was a combination of we hit a round number, we were really approaching our extremes, and this one right here was basically, it allowed me a 30-plus pip stop roughly and a 90-pip target back to the 20 EMA. So the trigger was a combination of the quantitative data on time as to how much was the max time in bars it could spend above the 20 EMA on a 4-hour time frame, along with hitting a round number. I said, you know what? Round number is as best as entry I was going to get. Why did I not wait for a higher tick above here? Well, guess what? Price hasn't been able to close above this. So if it does pierce above this, I'm going to have to be really fast to catch that. So I said to myself, I like the round number. I like the stop on this one here. This is the highest close to date as it's pressed up against this. I like this trade here. So this is my entry. So hopefully that answers your question. Okay, but you're not sitting. Unfortunately, you're not sitting next to me when I trade. Yeah, it would cost you a lot of money to make that happen. It would probably cost you several thousand a day. Why? Because if I'm not trading myself and I'm sitting next to someone helping them trade, I'm losing thousands of dollars. So hopefully answers your question. Chaos Theory says, have you broken the data down into percentages? After 35 bars, there's a 70% chance of touching the EMA. Yes, we have. We've done distributions. We've done, 1 sigma, 2 sigma. We've done all that, but some of that I'm not going to share, So some of it I will only share for members of my course. I'm making videos as we speak where I expose some of this data for people in our price action course. And some of it I will save only for the book. And then small pieces of data I will release in this webinar. So if you come to this webinar day in, day out, maybe I think I'm going to probably do it once or twice a month. I'll release quantitative price action data like this. So, yes, we actually measured for like 16 plus metrics. Stuff that, anything you could possibly imagine that would be highly useful. So, hopefully it gives you a rough idea. And Chum, you've asked this question again. Hopefully I've answered it. So, in terms of where you can get this data. Okay, let's see. Last few questions, and then I want to move on to one more aspect of this, and then I would like to move on to, silver on the 3-minute time frames, and then if I have enough time, I can talk about sterling dollar on the daily and oil and what I'm seeing in that. Okay, a couple more questions. Boils down to you have to do your homework. Dry Desert says yes. Boils down to you have to do your homework. And I did a. You got to remember, a lot of these questions. Find me a person who's been asking these questions. There's a couple authors out there. There's a very few authors on price action, and there's a couple educators on price action. But find me somebody out there that's asking these questions. I can't find them. I've seen every price action educator that there is out there, and nobody's asking these questions and then following up and collecting the data. I don't find anybody that's doing this. So that's why I consider myself a little bit unique, because I'm doing things that other people aren't doing. Okay, let's see here. Well, I mean a lot of one large... Greg says, do you consider quantitative price action data different from market structure? Yes, I do. You're talking a gestalt of things. It's more of like going from gestalt to an individual behavior that's going to repeat itself over time. So structure has a lot more moving parts. Quantitative price action data doesn't care about structure at all. It's just giving you raw data. So I like that aspect of quantitative price action data. Let's see here. RSM says, does anybody trade based on the historical data, what you are presenting? As far as I can tell, RSM, nobody. Again, hopefully I've answered that question. Nobody is. Nobody's presenting this data because nobody's been really going after this data. But in terms of your question, does anybody trade off this? The answer is yes. Institutions are trading off of quantitative price action data all the time. High-frequency trading systems are trading off of quantitative price action all the time. Absolutely. They're running massive amounts of algos and all kinds of statistics and probabilities. They have data on things that you wouldn't even imagine that you would want data on. And then they're looking for patterns, and then they're looking to how they can exploit that, and then they're trading them. So the answer is yes. As to the second part of your question, markets are never the same. Sure, that's true, and it's false at the same time. What do I mean by that? Patterns repeat themselves. The markets aren't just chaos, there's order. What are systems trading? They're trading patterns. What are quantitative systems? Patterns. They're algorithms and patterns in the market. So to say that there's absolutely no way to predict whether there will be one candle above the 20 MA or maybe 50, that's true. When the market closes above it, there's no way to predict that there's 1 or 50, but I can, based on quantitative data over a large enough data set, I can be pretty confident that if we're in the extreme ranges of this over the last 7 or 8 plus years of data, there's a high probability that this is not going to play out, especially if I know I have only had less than 1% of all of these long, moments above the 20 MA have barely made it above 40. If I know that we're checking for 2 sigmas plus of value, then I know that we're talking very extreme market behavior. And so the answer to your question is really yes and no. Yes, markets are never the same, and at the same time they are the same. Patterns repeat themselves all the time. I have quantitative price action patterns that can tell you, hey, this pattern is going to play out 70% of the time, and go figure, when I do the analysis, the trade reports on it, it plays out almost to the exact same percentage. Historically, over the last 7, 8, 9 years, the trading on this has been right around 70% accurate. Go figure. So I'm going to disagree with you that there's no way to predict these things. There are ways to predict it. That's how people make money. You don't make money off of randomness. Systems don't make money out of randomness. They make money out of patterns. So hopefully answer your question. Michael says, look out your window, Chris. See the English-looking dudes in bowler hats. They're coming. It'd be impressive if they find me, because I'm in a pretty remote place. And I have a wide view of the surrounding territory. So it would be impressive. Okay, last 2 questions, and then I want to move on. Chris, difficult to believe that you cannot trade 4-hour time frames with others. I'm not sure I understand that, what you mean by that. So hopefully you can restate that. Gam says, just missed the beginning of the webinar. As you mentioned, your book just then, is it definitely coming out on the 23rd? No, it's not definitely coming out. We've revamped the structure of it, and we want to include a lot of this new data, and since we're still crunching a lot of this data, we're still doing it. So Boyke says, how much to sit beside you in your compound? It's still going to cost you thousands of dollars a day. Rajesh says, 4-hour candles open and close are different in different MT4 brokers. Which time zone base is preferred? It really depends on what kind of trading you're doing. For example, if I'm basing these patterns off of GMT, well then I'm going to want to be trading off of GMT. If I'm trading off a New York close, I'm going to want to be trading on New York close. If you're not trading any particular patterns and you're just asking, hey, I want to trade 4-hour time frame, 4-hour price action candles, what time zone is the best? The statistics show us that New York close and GMT tend to be the best, but there are some systems that test it a lot better on European open. So it really depends on the system and the time frame. There wasn't one system that tested the same on all the time frames across the board, and there wasn't cases where all the systems were great on the New York close and bad on the European close. There was a mix of them. So it really depends on the type of system. If you had to pick one, I would say either pick GMT or pick New York close. And between the two, New York close would probably be better. So hopefully answer your question. Ganser says, do you also do the metrics for harmonic patterns? No, I don't do harmonic patterns. I do pure quantitative price action patterns. Dryder says, do today, quote, do today what others don't want to do, some that tomorrow you can do what others can't. Very good quote there. Dry desert. High-frequency trading systems are mostly designed by scientists, people who study particle physics, CERN stuff. These are smart people. Yeah, and they're using algorithms which are looking for patterns. So hopefully answers your question. Michael says 9 times 4-hour candles ties in with the idea of swings being 3 to 5 days, and the max above 42 is 7 days. Interesting. Yeah, it is. Okay, great. So with that being said, I want to go over one other instance of the quantitative price action, how I'm applying this here, and then I want to talk about silver on the 3-minute time frame and how I made 3 trades on that just using pure price action. Okay, great. So if you remember, one of the stats on the Aussie dollar was max consecutive bull bars on the 4-hour time frame was 9 bars. So here we are looking at the current chart. If we look at the current, let's take a look at this move here. 1, 2, 3, 4, 5, 6, 7. We were approaching the extreme there, and we were also approaching the same high as this. So this was a very good clue. We were coming towards an extreme, and when are the times that you want to reverse things is when you're coming towards extremes. That's the best time to reverse them. So this was a really good example of how that quantitative price action was very informative to us, saying, hey, you're coming towards an extreme. If you're looking to reverse, now is the time. You don't want to reverse necessarily when you're right in damn smack in the middle of the data, saying, hey, you have a 50% chance of this going up and down. That's not very useful. I want to know when I'm 70+% chance of this going down or this going up for me to really want to use that data. Now, in this case right here, taking a look at this most recent move, we have 1, 2, 3, 4, 5. If this bar closes up, we're at 6. So if it starts to get timid but still produces blue bars 7, 8, and 9 going to this, I will look to fade this again. If we get up here towards 8 or 9 consecutive blue bars in a row, I'm going to use that data to fade this thing. So because we've never historically over the last 7 years, which is a lot of data, saying, hey, never been able to have more than 9 candles, consecutive 4-hour candles, be all blue or all red. In this case, all blue. And so to me, since we're at those extremes in the data, I will be looking to fade that if I get 2 or 3 more bars there. So hopefully you all can see and grasp and gather why this price action, quantitative price action data can be highly valuable. All right, with that being said, I want to switch into another chart. Give me a second. I'm going to reduce this one down. And I'm going to put up a 3-minute time frame on the silver, and talk about how I was able to make 3 trades on that one, just using pure price action. Okay. So silver started day, this gray line here is the London Open, and it started the day with a brief consolidation, but then it spent a large portion of its time above the 20 EMA and in an up move. So it started off mostly with a lot of buyers. Then after having a pretty solid 2-legged pullback, with the second leg being stronger than the first leg, this second leg has bigger candles, they cover much more ground. With the second leg, a lower high, and the second leg being stronger, you would think that this thing might have some continuation on it. Well, all of a sudden, it runs into a support level at 29.61. Stops on a dime. After 15 minutes of selling, going from 29.84, 29.61, which is 23 cents on silver, and the higher high, or the lower high, confirming this rejection here was legitimate. After going from here to here, it stops on a dime at 29.61. So let's zoom into this. Now, if you take a look at this, we spent most of the time above the 20 EMA, and then we had a pretty good punch below it. But then it starts to move sideways below the 20 EMA, suggesting that the selling pressure is starting to get absorbed. The offers are starting to get absorbed. This strength all of a sudden ran into something and then just zapped out of the market. So what is that communicating to me? The 2-legged pullback is probably coming to an end, And if it starts to produce some buying pressure, I'm going to look to trade that. Now the question then becomes, if I'm going to look to trade that, how am I going to trade that? Well, I have two options. I can trade above the high of this lower high here, not my favorite, or I can say, you know what, I want to trade above the prior swing high for the day, which was right here. This is where it hit, and this is where it stopped on a dime. Why is this level significant to me? Real briefly, I just want to go to a daily time frame, and I want to show you fib level that I've been watching. Right, oh, I got to drop that a little bit. Right, there we go. So, right at this prior fib level here. It was also really close to this high here. So we have a fib level that's very close. We have price action rejecting off these levels here. And then when we drill down to an intraday time frame, like the 3-minute time frame, this was our intraday swing high. Why did it do that? Okay, great. So here's our intraday swing high for the day. It was a place where the market, after being very well bought up on the open, had a dead stop, created a two-legged pullback, and then the orders got absorbed, the offers got absorbed here. The offers get absorbed after a two-legged pullback, and look what happens. Candles start increasing in size. If the candles start increasing in size after hitting a kind of flat point or a dead point where it just stopped on the dime, well then that's telling you that the offers got absorbed and then the buyers came in and started increasing buying pressure. How do you know that? Well, how do you increase buying pressure? You increase the size of the candles. Each candle starts gaining in size. That means that more orders and more buyers are coming into the market, either in more money or greater volume or more numbers of order. So in other words, more buyers are coming into the market or both. You have more buyers, more money, or both. That's how you create buying pressure, and that's how you create a series of candles that are increasing in size. Look what happens to these candles after they make a nice little run up. They stop for a second, brief pause, holds near the highs, and then look at this candle here. Candle opens, just dips a couple points down, and then breaks through, confirming there were good buyers on the breakout. So that is a really good setup for me to take a breakout retest to the prior swing high. So I took that same pullback to the prior swing highs, and the price action confirmed to me that the buyers were still in control. How do I know the buyers were still in control? I just had 12 minutes of selling, 4 red candles in a row. Well, take a look at this. 4 red candles of selling couldn't even take out all of the gains from 1 3-minute candle of buying. I've done this setup on 1-hour time frames, on 4-hour time frames, on daily time frames. This is what I was talking about. It's the exact same technique, just on a smaller time frame. So look what happened. This was communicating to me the sellers were not in control because they needed 5 candles just to even come close to covering all this distance that one buying candle was able to produce after breaking out. So I took the pullback here. I said, you know what? I want to stop just below the low of this little candle right here. This little candle had a low right over here. So look at that, stop just a little bit below it. My choice was actually below all of these right here. I actually placed the stop at 81. That was my exact trade. 29.81, gave it a few cents, an extra 3 cents breathing room. And then what was my target? Well, I wanted a 2-to-1 ratio on this one here. So I minimally wanted 20 points. So 20 points would have been 30.11. And I'll tell you why I actually exited 1 point above that. And I'll give you just a hint in just a second. So we've had the breakout of our prior high. I get a nice price action confirmation signal here that, hey, the market is probably going to be bought up again. This confirms that my entry was great. I got in at 29.91. I was a total of, 6 pips off the lows, and I had a 20 points. I had a 2-to-1 target on that one there. This candle opens. There's not one tick down, It just gets bought up from the open and makes new highs, confirming to me that my entry was good and the buyers came in with new force because they broke the prior highs, they opened, they didn't go one tick down, and they closed near the highs, communicating this thing was bought up from the open. Then the next candle does the same thing, opens, doesn't go one tick down, and then gets bought up from the open. Now, in the close of this candle, I'm looking at this saying, okay, great, I'm pretty close to my I have my 2-to-1 target, so I should be looking to get out. But I just had 2 candles of very strong buying. So I said, you know what, let's see if this continues. Well, what happens is the market opens, bumps up a little bit, and then starts to eat into a good portion of these gains. Keep in mind, this is a 3-minute candle. So going into the last 20 seconds, I'm sitting here looking at this saying, hey, this is now starting to threaten my 2-to-1 ratio. Let's see how this thing closes here. If it gets really significant if it gets towards the highs of this, I'm going to exit out because I don't want to sacrifice any more at that. It closed right here, and I said, you know what? Instead of having 4 bullish candles in a row and continuing the buying pressure, it must have run into something, and so it sold off. On the close of the candle, I exited, and ironically, I got my 2-to-1. Now, real briefly, what did this thing run into? Let me show you. Sorry, daily time frame is what I want. Remember that high? It went up to just above 30.15. In fact, the 3-minute candle went up to about 30.18. Well, let's take a look at this. What was the high of this candle? 30.18. So it ran into a prior high that was mid-December and then rejected off of that on the 3-minute time frame. This is why it's important to be able to understand some of the key levels on the higher time frames, because if you're just trading 3-minute time frames or 5-minute time frames, you probably will not see this information. So it's very important that you're aware of key levels going into a move like this. Now, with that being said, I've gone over a lot of information on how I traded this on a 3-minute time frame. There's actually 2 more trades I'd like to go over. Let me go over one more trade real quick. Well, actually, let me see. There's nobody after this. So, all right. Well, let me go over the second trade real quick, and then let me see if I can get in some questions. So now we know how the first trade was. 29.91. Stop was 28.81. I exited right here, 30.11. Let's talk about the pullback. I did a pullback, and then I did another buy, and we'll talk about the 2 trades. Take a look at this structure here. I want to delete a couple levels, and I want to keep a key level in here. Take a look at the structure here. So we have pretty strong buying pressure. This pullback is a lot more serious than this one. So telling me the sellers are starting to get a little more confident, but then the bulls come back, take out the new high, and look what happens. The bulls take out the new high with this candle. Now, if there really is good follow-through buying pressure, this should continue for a little bit. But look what happens on the first candle after it breaks the new high. Makes a new high, sells off, closes about 40% in, and then sells off and breaks down past these prior highs. So this is the first time in a while, we've broke above a new high and then broke down pretty significant into the prior price action bullish structure. This made it pretty deep into it here and way below these prior highs. Then look at this next setup right here. Take a look at this one here. We have pretty strong sell-off. This is the strongest sell-off of any 4 candles to date throughout the day. These 4 candles don't qualify. These candles don't qualify. This is the strongest 12 minutes of selling to date, so I should be watching this. Weak sell-off, medium sell-off, strong sell-off. Maybe the sellers are starting to take over control. What would I want to see? I'd want to see a lower high to do that. So guess what happened? I produce a lower high and then start to break down. Now, what was my trigger to go short on this one here? I had a really tough choice on this one, and I'll explain why. Because I didn't catch this high right here. I wanted to see a lower high confirmed before I started doing this. So I had a tricky trade here. How am I going to get in? I had two options. Am I going to get in on a close below the 20 EMA and take a pullback to the 20 EMA? Many of you know I like to trade pullbacks to the 20 EMA after been in a trend and we break that trend. So that was one option. The other option was sell one tick below this here. Well, here's how it ended up playing out. I said to myself, if I'm going to sell it, where do I think this thing is going to go before I want to get out? I had two choices. I had this level right here, which was breakout pullback. Many of you have seen me do this on a 4-hour time frame. So I had 29.99, and then I had this level right here. To me, this one was the more key level. Why? It was the intraday swing high, and it produced a much stronger rejection than this one did here. So since it produced a much stronger rejection, to me it had more emphasis, more price action, more ticks, more order flow around that. Therefore, to me, this was the more choice level. Okay, so now I've picked my target. I want to be selling, or I want to be exiting out of the trade towards 29.91, and I could be getting in at 30.07. Keep in mind, I'm having to do this really fast. This is why I don't recommend, as you're learning to trade price action, doing it off the 3-minute time frame, because you have to do this really fast. You have to make a lot of calculations really quick. On the 1 hour, 4 hour, and daily time frames, you have more time to do this, and it doesn't get too stressful doing this. So I said, you know what? I actually like taking the pullback to the 20 EMA. Why? It gives me a slightly tighter stop. My stop is going to be just above this swing high here. So look for, say, a 30.25. I like that. I get a pullback to the 20 EMA, and look at my target there. I have about a, what is that, a 21-cent target and a 13-cent stop. Not my favorite, generally below the 2-to-1, but it's workable. Now, is there another option for my stop? There is, just above this prior high. Now that really tightens my risk. 9-cent stop, 21-cent target. Now I'm really liking it. So that was the play I ended up making. And it hesitated a little bit, but I'll tell you what I was reading in real time. This is where I was a little bit concerned that I might not make it, and I'll tell you why. We had some decent selling, but this selling is not as forceful as this selling. It's at a flatter angle, it's covering less ground and more candles, and we have 3 strong rejections off of the 30 level here. So I started to look at this and say, I'm a little concerned about this. But then, guess what happened? It now closes right on it, pierces below, and I said, okay, I need one more pierce below this for me to feel like, okay, I'm going to hit my target. And look what happens. The next candle, the pressure yielded. The intraday buyers that were here at the 30 level said, we yield, and boom, they let go, and the thing went right to the target. So it took me about 27 minutes to gain about 21 cents on that one there. And so that was that one right there. But then I looked at this right here, and I said to myself, wait a minute. Remember the intraday buy levels? My stop was at 29.81, and I was buying at 29.91 here. I said, okay, we've now had an aggressive move down here. After the most aggressive selling candle, we have a rejection, and then we have another rejection. So I said, you know what? If I buy on the open, I'm buying at 88, stop just below 81, 8-cent stop, 9-cent stop, and what can I do as a target? 16 cents is my minimum 2-to-1. So what would that be? 16 cents from 88 is 98 is 30.04. That places it right about here. And guess what happened? At the time that we were starting this webinar, let's take a look at the time. Look what happened. Opened, this candle held, it comes right back to the same level. Obviously, buyers are coming in here. This confirmed it. The buyers came back in and bought back up here because they bought up at a higher low, closed on the high. The next candle opened, didn't produce one tick lower, closed on the high, continued buying pressure. Take a look at this candle right here, 7:06. Here was the 7 o'clock time, and this is where I ended up closing out on the close of this candle. So I closed about 2 cents below my target because we had to start the webinar. So does everybody see? I know that was really fast, and that's the thing. When you're trading price action on a short time frame, it is really fast. You have to make really fast decisions, and it takes a lot of practice and skill set to do that. If you notice, almost all the techniques I've been using there were the exact same techniques that I was using on 1 hour and 4 hour and daily time frame. No new magic, nothing special, same stuff. That's why I recommend starting on the 1 hour, 4 hour and daily time frames when you're trading price action, because to make those decisions really fast without having a lot of experience and skill set, it becomes a lot of pressure on you, and it becomes a lot of decisions you have to make. I wouldn't want to be making that my first year in trading. Only after I've seen thousands and thousands of price action formations would I really want to be making those decisions. Plus, you have to do the mathematics. You have to do the math in your head really fast, and that's not easy. So with that being said, if you're still learning price action, you're still getting comfortable with it, or you haven't been able to make it profitable, start on the 1 hour, 4 hour, and daily time frames, and then after you've made that profitable, if you want to shift to a lower time frame, then I would suggest doing it. Then you can do it. Just keep applying the same techniques. Just be prepared to shoot faster. So does everybody understand some of the price action techniques I was using? Yes, no? Can everybody see that? For those of you that have been in this class for a while, did you guys see me use anything different? Anything different? Not at all. Nobody saw me use anything different for those of you that have been doing that. So if you're going to learn, why not learn on a time frame that really gives you the time to see all the stuff, see all the critical information, make all the decisions, and not have to feel like you're being squeezed into a small hole to jet everything out. Learn to do it on the 1 hour, 4 and daily time frames is going to be far easier, and it's going to accelerate your learning curve. So hopefully answers your question. All right, cool. Dry Desert says, do I consider this a do I consider this a head and shoulders pattern? No, I don't. And especially I don't consider it. Michael says, is this silver 3-minute head and shoulders? Yeah, hopefully I've answered your question. James says, did you move your stop to break even when you thought the trade was running out of steam? Yes, I did. I moved it to break even on the first long, not the other two. James, I doubt Spiro will want to come in here. Spiro seems to hate me. He's like one of the only persons in Forex Street that hates me. In fact, every time I write an article, he seems to be writing a counter article just to tell people my shit's stupid, which is hilarious. So it's pretty funny. So I wouldn't recommend it. He's welcome to come. I totally welcome to be here, but he just always seems to argue against me. Everything I say seems to argue against me. Ashish says, sorry I joined this webinar late. Can you confirm if you'd use this on the 1-minute setting as well? I don't. And I like the 3-minute time frame because price action seems to run really well on that, particularly for the pairs that I'm using. It's also that much faster on the 1-minute time frame, but on top of it, I have kind of a superstition around numbers, and 3, 6s, and 9s. Anything derivative of 3 tends to bring me good luck, and so I tend to do a lot of my trading. Even my entries tend to be around 3, 6s, and 9s. Multiples of 3s. So I was looking at intraday time frames, and out of all of them, the 3-minute time frame for me was the most enjoyable. Price action seemed to move the most rhythmic. That's just for the style of trading I like to do. So hopefully I answer your question. You can do it. It's just not my favorite. Matahari says, those bounces on silver is occurring at the daily pivot R1, R2, and 3. It is very obvious. Actually, I'm going to disagree with you on that one. Here's my daily pivots, and my daily pivots are based on the London Open. Even when I ran them on the New York close, they weren't on the R1, R2, R3. Nothing was matching on the R1, R2, R3. And so, in fact, we were way above the R1, R2. We were above the R3 at the time that this happened. So I don't see how you were using that. But to say that it was obvious, maybe the pivots that you're using, but I tried both pivots on New York close and London open, and those are the most popular pivots out there, and they weren't matching up with any pivot. So I don't see how you can say they were obvious. And if they were so obvious, did you trade them yourself is the key question. Spanky says, understood. Is there a PDF on some of this? No, but this is recorded. So FX Pro uses European Open, and European Open is not the best pivots out there. European Open, let me explain why. Server time for FX Pro is European Open. Why is European Open not the best? Well, where are the largest amount of transactions happening for currencies? London. Where are the most amount of transactions happening for commodities? Coming out of the U.S. So with that being said, in terms of Forex, London traders are going to be using London pivots that are based on the London Open. And so therefore, if you're going to be using pivots, I'd recommend using them for Forex. I'd recommend using them off the London Open. The only other time frame that I recommend is New York close. Why? Because when you have daily candles that are based on New York close, you're going to have 5 pure trading candles, and the close on Sunday and the open on Monday match up very nicely to create 5 really clean candles. So that's why I suggest New York close. If you're going to use London Open for intraday pivot tradings, then I would recommend London Open. Why? Because there's more traders coming out of London and trading Forex out of London than anywhere else. And what pivots are they using more than anything else? They're using London pivots. So if I had to recommend, those would be the ones I would be using. Just my thoughts on that. You're welcome to disagree. I have no problem with people disagreeing with me. Dry Desert says, last few questions here. Oh, wait, sorry, I got to get the other questions here. Dry Desert says, to make it more clear, I have a problem deciding whether a situation I'm seeing on the chart is ready for a trade or if there's simply not a setup yet, and it is still time to wait. The way out of that, Dry Desert, is to have rule-based systems, to have rules for all your systems. If you have rules for all your systems, then you really shouldn't be making too many decisions. It should just be, hey, there's a trade set up, so I'm taking the trade. Or, hey, I don't have the rules for my trade, so I'm not taking the trade. If you do have full rule-based system where all the rules are explained out, A, B, C, I need all these to be in to get in my trade. If you have all the rules in place, but yet you're still not making the trade, and yet they're all in place to activate the trigger, well, then there's probably something going on psychologically which is influencing that. So with that being said, I would definitely recommend doing it on the 1 hour, 4 and daily time frames. Why? Because you'll have less decisions to make. You have more time to clarify the information for yourself. Hey, all my rules are met. Hey, all the things is there, or not. And so practice on that, get skilled on that, and then once you can be consistently profitable on that, then you can decide if you want to move to smaller time frames. So that would be my recommendations on it. Matahari says, I find very successful in using them just like the success you find in your own stuff. If you do, Matahari, then great. Stay with it. I have no problem with that. You know, the important thing is if it works for you and if you have a long track record of it working for you. Do you have 6 months, a year, 2 years, 3 years, 5 years, hundreds of transactions of that working? If you do, stick with it. There isn't one way to trade. There are thousands of systems and thousands of ways to make it work. The important thing is, can you make what you have work? If you can't, then you need to try something different. But if you are, and you've been able to do it 6 months, a year, 2 years, 3 years, year in, year out, then stick with it. So if you do, stick with what you're doing for sure. I use my pivots based on slightly different setups, but if it's working for you, stay with it. Okay, so a couple questions above. Dry Desert says, right after a trade when the trade is closed and the price goes the other way, would you wait a while until you get a new conclusive picture before you consider new trades? This is probably impossible to answer because it's so general, but as I am a beginner. Okay, here's the thing about your question, Dry Desert. I want to break this question down. You're saying right after a trade when the trade is closed and price goes the other way. Let's say you were a bullish trade and price started to go bearish. Would you wait a while until you get a new conclusive picture before you consider the new trades? Why do you need a new conclusive picture? If you had a bullish bias and then it started to go the other way and you're feeling like I need a new picture before I can make the trade again, that could be, this is just my insight into your statement, it could be because your bias is still bullish and you're looking for more bullish trades. As a trader, we have to have no bias. We have to be thinking to ourselves, this thing can go up, this thing can go down. I am not monogamous to it being one side or the other. I'm only monogamous to my systems and the price action. If it's going the other way, it could be because there's a price action trigger that's saying, hey, we're turning ship. We're turning course now. Price will turn faster on shorter time frames than they will on other time frames. So if you have a hard time with changing directions quickly, then it might be good to trade on higher time frames. But if you can really switch gears fast, then smaller time frames will be workable. But if you can't switch gears fast, then you definitely want to stay in higher time frames until another setup appears in the same direction that you were still thinking the market was going to go. So that's just my thoughts on it. I don't wait for the market to change picture. I'm really looking, is the price action communicating to me we're going up or down? And if it is, then I'm just looking for a setup based on that direction. So hopefully I answers your question. Avier says this was recorded. Yes, it was recorded. Arichiga says, when you trade, is winning what has to happen in price action to put a break even? I think what you're saying, Arichiga, is when your trade is winning, what has to happen? Okay. What has to happen in price action to put it to break even? It's not so much a question of price action, it's more a question of distance. First, it's really distance. Like, have I gained enough? Am I profitable enough in my trade to bring the stop to break even so that if I was to do this many times, time and time again, that my overall mathematics are still going to keep me as a profitable trader? If I'm putting it to break even only a couple points above, I could get kicked out of a trade that could really go to my profit target, and so we have to consider the mathematics of it. First, it's really mathematics. Then second is price action. Hey, is this thing really showing that it's going to hold above it? Maybe above the 20 EMA, maybe it's showing we're bullish and it's showing corrective moves to the bearish side and that the offers are getting absorbed. It could be something like that. It's not one thing. But generally, I want there to be enough profit to be in play for me to say I want to move this to break even. So then I know the mathematics are in my favor. So hopefully answers your question. Boyke says 20 is not a derivative of 3. I'm not sure what you're referring to there. 20 is not a derivative of 3, so perhaps you can help me out there. Dry Desert says, okay, I think I've answered Dry Desert's question, so hopefully I did. Boyke says in New York closed pivots. Hopefully I've answered that. Maybe you have a new question. So Soma says, would you start with only one pair as a beginner? If you are an absolute beginner, I would say 1 to 2 pairs. And depending on your style and depending on how you like to trade, it would depend on what pairs you'd want to do. So it's a very good question. It really depends on what you're looking for. Yeah, Dry Desert. If you're taking the first steps without a system, then that's probably why you're experiencing that. Not having a system and not having rules to make your decision, you're going to be out there with having no rules for your system is like having no sail on a boat and no rudder. You're like a rudderless boat. And so the rules help to clarify if what you're doing is working or not, which parts of the rules are working or not. It allows you to start to isolate variables, very much like a scientist. So that's why I always recommend trading rule-based systems. Even if it's discretionary, having some rules will help you filter out what is working and what is not. Drydo says, Chris, doesn't require an answer. Okay. I have no attachment to an assumption I made earlier. I'm more a bit shaky on my feet altogether. If that's the case, then you're going to want to start moving towards a rule-based system. It doesn't even matter if the system is highly profitable or barely profitable or even break even. Just engaging in rules will help you feel like you're isolating key variables which are working or not, and then through your experience, you'll start to understand, wow, these variables are working and these ones are not, so I can start to use these to build a system or a trading style that works for me. That's my recommendation about it, but definitely move towards creating more and more rules. Alright, Chica says, why you don't use trend lines if you're using price action? On a 3-minute time frame, I'm not really too interested in trend lines because they're gonna be so meaningless in a short period of time that by the time I set those things up, they're not even worth it. I'd rather just use pure price levels. On a 1-hour foreign daily time frame, they are going to hold for a much longer period of time. More people are going to see them, therefore, more people are going to trade them. And so that's why I use them on, higher time frames. But on lower time frames, I don't use it. But as a whole, I generally don't use trend lines too much. I just use them once, spot them mentally, and then that's it. I want my chart to be as clean as possible. James says, you still use the 3 amigos on your charts, Chris? That's actually part of a proprietary system, so I don't want to talk about that, James. And if you know the proprietary system, I would appreciate if you don't share any information on that, because that's really unfair to the people who have paid for it, that information, to give it away for free. So that's just my thoughts on that. Dry Desert says, I have a problem choosing a system. Well, the answer to that, and that's a great question because a lot of people in their early stages run into that. And so the questions you should be asking yourself in terms of choosing a system should be, do I like trending? Do I like ranging? Do I like to trade reversals, or do I want to be with the trend? Do I like to hold trades for a decent amount of time? Do I not like holding trades for a decent amount of time? Do I want to have to sit at a computer for 6, 7, 8 hours? Or do I have to, or am I more comfortable just making a couple trades, like a trade, and then walking away from it and letting it play itself out? Those are questions you have to ask yourself, and it's very important to know yourself and who you are and your tendencies. But before you really start to engage in finding a system, because finding a system is it's like finding a golf club. You need to have something that really matches the way you like to swing a golf club. If you're using one that doesn't fit your style, it's not going to do it. So, with that being said, that's my thoughts on that. Yeah, to be honest, Dry Desert, I don't recommend spending too much time on forums. Why? Because if only 25% of the people are making money out there, then that means 3 out of the 4 people that are talking on a forum aren't making money. And so I generally don't like to listen to crowds of people where 3 out of 4 of them aren't making money, day in, day out, year in, year out. So to me, I don't really recommend spending too much time on open forums. I recommend on closed forums where there's one person teaching them, because then you're getting one stream of information, and it's somebody who has experience in the market, it's somebody who's been successful, who is successful, who knows what they're doing. They are the ones dispensing the information. If you've got 100 voices on a forum, or 1,000 voices on a forum dispensing information, yet 750 of them are not making money, then you have to know who really knows what they're talking about and who doesn't. And so that's my recommendation on that. I generally don't recommend open forums for mining information. You're not going to find professionals looking through forums to mine information about how to trade. And it's generally not how they got started. Yes, James, it is proprietary. Okay, let's see here. Trader, so my personal as Michael says, it's self-discovery, discovering your own trading personality, and that's something that you have to spend some time working on. So hopefully, spend some time on that. Definitely really think about it. Ask yourself what situations do you feel most comfortable in, which ones do you not. And then once you've kind of isolated some of those variables, then you can start to really start to kind of engage in looking for, more specific systems on that. Okay, last two questions, and then I gotta go. So there's a lovely woman in a bikini sitting outside at my door window teasing me, telling me that it's time to go. So last few questions there, that's it. Carla says, do you believe that it will be useful to use quantitative price action stats on a shorter time frame, let's say 5, 15-minute? Would counting the number of candles above or below 20 may be useful? Gives us any valuable input? I think it would be useful. I think it can be useful. We are still doing testing on time frames, very short time frames to see, can we get 2 sigma variables? Can we get stats that are showing extremes that don't happen often? Can we get data that has a lot, it's a large enough data set and has enough instances for us to really consider the data set to be useful? Because when we're looking at shorter term time frames and measuring this algo, we got 2 things to consider in terms of the data set. One, how long is the data set? In other words, how much data can I get on the 3-minute time frame going back, or 5-minute time frame? It's very hard to get 5-minute data going back years and years and years and years. Yet on a 1-hour, 4-hour daily time frame, I can get that. On a 4-hour time frame, I can get about 10 years worth of data. It's very hard to get 10 years worth of data on a 5-minute or a 1-minute. And so hopefully answers your question. So we have the data set, how large is the data set, and then we have how many instances. How many times does this occur? It has to have enough instances for it to really be statistically significant. So that's the things we have to consider. And so we're still crunching the lower time frames, but 1 hour, 4-hour, and daily have enough instances and a long enough data set for me to be doing that. Michael says, Chris, rule-based price action systems are great, plus his trend pullback trades, great place to start. Thanks for the compliment. I appreciate it, Mike. Kestis, did I go to Japan? Not yet. I will be probably second half of this year. Okay. With that being said, I'm way past my 15 minutes. And again, the lady with the bikini is outside my window and telling me it's time for lunch and some other activities. So with that being said, I'm going to get going. But first off, I want to thank you all very much for coming. It was great having you guys here. Fantastic to be back. We're back at our normal scheduled time. Everything's the same as it was before. So I hope you enjoyed this new format. I hope you guys got a lot of valuable information about it. This webinar was recorded, so make sure to come back over the next few days and listen to it again and again and again. There's a lot of pieces of information. Other than that, if you have any questions about our services, what we do, make sure to check us out, secondskiesforex.com. And if you have any questions for me, info@secondskies.com. I bid you all adieu. Good luck trading. I'll see you guys next week. Take care, everyone.